For more on what all this could signal for markets and the economy in the second half, let's bring in CNBC contributor Peter Boockvar. He is Bleakley Financial Group's Chief Investment Officer. Peter, great to see you. Did you learn much? You said nothing new came out of the minutes.
Nothing new, but anybody looking through the minutes to try to find any hint of dovishness didn't really find it. And I think that's why the rate hike odds for July didn't really change at around 82%. Now, can that change with Friday's payroll number or next week's CPI? Maybe, but it seems that the Fed is at least intent on going one more time. I say one more time because I think this is one more time too much, and I find it hard to believe that they're going to go past this because of the restricted nature of where we are today.
You know, Karen was making the point just now, Peter, that, it's been 15 months since the first rate hike, and shouldn't we start to see some of the lag effects at this point? And I'm wondering, based on how do you think those lag effects are going to manifest in the economy if we're not really seeing so much right now? What are you expecting if you think the Fed is going too far already?
It's happening every day, but it's not making it on the front page of the Wall Street Journal. It's happening to the person whose adjustable rate mortgage just came due. It's happening to the business that has a loan coming due or has a floating rate piece of paper that is resetting. It's happening every single day. Somebody's seeing a dramatically, sharply higher cost of capital because every day somebody's loan is coming due, whether it's a business or a household. So this is sort of a silent killer, in my opinion, to economic growth that we don't see headline nature-wise, but in a cumulative perspective, it's happening over the next couple of quarters, over the next couple of years, if rates stay at these high levels for a while. More money is being allocated to interest expense. Bankruptcies are picking up. Commercial real estate projects, we know, are handing back the keys. This is just, like I said, a silent impact on the economy that is not front page news, but it's happening every single day, and somebody's getting caught with too much debt or an unlevered, or I should say an unbalanced balance sheet.
Peter, thanks so much for your time. Bono one here. So there seems to be a lot of attention paid to the absolute level of rates. But one thing that the Fed officials were unanimous about was the desire to shrink balance sheet. Would you mind speaking a bit about that and the effects that perhaps are being overlooked on that aspect?
Well, I agree. And I know Dan was talking about it earlier. Probably on Friday, we'll see the balance sheet of the Fed get finally back below where it was right before SVB collapsed. So I think the balance sheet shrinkage is going to be now more notable from here from a contractionary standpoint. And we know QE was meant to lift asset prices. QT does the reverse, even though it's sort of been put to the side because of these other liquidity things with the RRP, for example, and the TGA and so forth. But I think from here on out, from a liquidity standpoint, it begins to matter. Now, this is also sort of behind the scenes. But I think while the Fed may be done about raising interest rates, whether they go one more time or not, they're going to rely on higher for longer, and they're going to rely on the continued shrinkage of that balance sheet. Now, where the balance sheet's going to go and where they're targeting, we don't know eventually where it settles out at. But I know in the Fed's mind right now, they hope to shrink the balance sheet by another $1 to $2 trillion from here.